When interest rates stay high, the standard headline is simple: avoid REITs. The logic sounds reasonable. REITs often use debt, higher interest rates can increase financing costs, and attractive Treasury yields give income investors a lower risk alternative. But that conclusion is incomplete. A REIT is not simply a dividend yield sitting next to a Treasury bond. It is an operating business that owns properties, collects rent, manages expenses, signs leases, develops assets, refinances debt, and allocates capital. Higher rates create pressure, but they do not affect every REIT equally. A company with weak properties, excessive leverage, large debt maturities, and a poorly covered dividend may face serious problems. A company with high occupancy, growing rents, mostly fixed-rate debt, and access to capital may continue expanding even in a difficult environment. That distinction creates both risk and opportunity. The goal is not to decide whether all REITs are good or bad because rates are high. The goal is to identify which businesses can absorb the pressure and which ones only look cheap because the fundamentals are deteriorating. To understand that difference, we first need to establish the actual interest rate environment REIT investors are facing in 2026. In mid-2026, the Federal Reserve's target range for the federal funds rate remains between 3.50 and 3.75%. At the same time, the 10-year U.S. Treasury yield was approximately 4.58% on July 14, 2026. Those numbers matter because REITs are competing for investor capital. An investor seeking income can purchase a Treasury security backed by the U.S. government and receive a meaningful yield without taking direct property, tenant, or corporate balance sheet risk. That means a REIT can no longer attract investors simply by offering a 4 or 5% dividend yield. It must offer something more. That additional value may come from rental growth, property appreciation, development opportunities, inflation protection, dividend growth, or a valuation discount large enough to compensate investors for taking more risk. This is the first major shift in a high-rate environment. When safe yields are close to REIT dividend yields, investors become more selective. Weak balance sheets receive less forgiveness, and expensive REITs can experience valuation pressure even when their operations remain stable. But interest rates do not affect REIT prices through only one channel. They influence financing costs, valuation models, property values, and investor alternatives at the same time. So the next step is to understand exactly how that pressure moves through the business. Higher interest rates can pressure REIT valuations through four mechanisms. The first is the discount rate. A REIT is worth the present value of the cash flows investors expect it to produce in the future. When required returns increase, those future cash flows become less valuable today, even if the underlying buildings continue collecting rent. The second mechanism is debt cost. When existing debt matures, the REIT may need to replace it with new financing at a higher interest rate. That increases interest expense and leaves less cash available for dividends, acquisitions, and development. The third mechanism is competition from bonds. When Treasury yields rise, investors can obtain attractive income with less business risk. REIT prices may need to fall, or expected growth may need to improve before the risk-reward becomes competitive again. The fourth mechanism is property valuation. Commercial properties are often valued using capitalization rates. When cap rates rise, the estimated value of a property can decline, even if its net operating income remains stable. These forces explain why REIT prices can fall before their reported earnings weaken, but they also explain why the impact varies so much. Rates affect the financial environment. The properties and management team determine how the business responds. And that is why treating REITs as simple bond substitutes can lead investors to the wrong conclusion. A traditional bond is primarily a contractual financial instrument. The investor lends money, receives scheduled interest payments, and expects the principal to be repaid at maturity, assuming the issuer remains solvent. An equity REIT works differently. It owns or operates real estate. Revenue comes mainly from tenants paying rent. The company must maintain the properties, negotiate leases, control expenses, manage occupancy, finance acquisitions, and decide where new capital should be invested. The basic operating equation begins with rental revenue. After subtracting property-level expenses, the company reports net operating income, commonly called NOI. From there, the REIT still needs to pay interest, corporate expenses, recurring capital expenditures, and other obligations before cash can ultimately support dividends or new investments. This operating structure means a strong REIT can grow. It may increase rents, improve occupancy, redevelop properties, acquire assets below replacement cost, or develop new buildings at attractive expected returns. A bond usually does not have that type of internal growth engine. But the same structure creates additional risk. Tenants can leave, expenses can rise, properties can become obsolete, and management can allocate capital poorly. So the critical question is not simply whether interest rates are high. It is whether the REIT's operating performance is strong enough to offset the pressure created by those rates. Before assessing growth, however, investors should examine the most immediate balance sheet threat, the debt maturity schedule. The total amount of debt on a REIT's balance sheet matters, but the timing of that debt can matter even more. Imagine two REITs with the same amount of leverage. The first has debt maturity spread gradually across the next 7 years. Only a small portion needs to be refinanced in any single year. The second has a large concentration of debt maturing during the next 18 months. On paper, their leverage ratios may look similar. In practice, their exposure to high interest rates is very different. The first REIT has time. It may use retained cash flow, asset sales, new equity, or improving capital market conditions to manage upcoming maturities. The second REIT may be forced to refinance a large amount of debt while borrowing costs are still elevated. If old debt carried a 3% interest rate and replacement financing costs significantly more, interest expense can rise, even if the total debt balance does not change. That increase can reduce funds from operations, weaken dividend coverage, and make new acquisitions less attractive. This is why the maturity schedule is sometimes more important than the next Federal Reserve announcement. A future rate cut may help eventually, but it cannot change a refinancing deadline that arrives next quarter. To evaluate that risk correctly, investors also need to know whether the REIT's current debt carries fixed or variable interest rates. One reason many listed REITs do not feel the full impact of higher interest rates immediately is that most of their debt is fixed rate. In the first quarter of 2026, approximately 89.3% of the aggregate debt held by U.S.-listed REITs carried fixed interest rates. Only about 10.7% was variable rate debt. The industry's average debt maturity was approximately 5.9 years, while the weighted average interest rate was around 4.1%. These numbers help explain why higher policy rates do not instantly reprice the entire REIT sector. Fixed-rate debt protects the borrower from immediate increases in market interest rates. If a REIT locked in long-term financing several years ago, its interest expense may remain unchanged until that debt matures. Variable-rate debt behaves differently. Its interest costs may adjust more quickly as benchmark rates change, placing more immediate pressure on cash flow. But fixed-rate debt is not permanent protection. It delays the problem rather than eliminating it. Every fixed-rate obligation eventually matures, and the REIT may then need to refinance at the rates available at that time. Industry averages can also hide significant company-level differences. One REIT may have minimal maturities and almost no variable rate debt. Another may have a much weaker structure. Once the debt profile is understood, the next question becomes more constructive. Can operating growth outrun the increase in financing costs? The answer is yes, but only when the underlying business is performing genuinely. During the first quarter of 2026, aggregate funds from operations for U.S.-listed REITs increased approximately 14.8% compared with the same period 1 year earlier. Aggregate net operating income grew approximately 5.6%. Same-store NOI increased around 3.8%, and equity REIT occupancy remained near 93.2%. Those figures do not mean every REIT was thriving. They do show that a high-rate environment does not automatically stop operational growth across the industry. A REIT can offset higher interest costs through rent increases, stronger occupancy, contractual lease escalators, successful development projects, and acquisitions that generate returns above the cost of capital. However, investors should separate operational growth from financial engineering. FFO may rise because operations improved, but it can also be influenced by acquisitions, asset sales, financing decisions, or comparisons with a weak prior period. That is why same-store NOI, occupancy, leasing spreads, and tenant health deserve attention alongside headline FFO growth. The best scenario is not simply rising earnings, it is durable property-level growth supported by a balance sheet that does not require aggressive refinancing or constant share issuance. When operations and financing work together, high rates can become manageable. But even a strong business can become a poor investment if investors pay the wrong price. That takes us from operational analysis to valuation. Higher interest rates can reset REIT valuations in both the public and private real estate markets. At the property level, one common valuation formula divides net operating income by the capitalization rate. For example, if a building produces stable NOI and the market demands a higher cap rate, the implied property value declines. The property may not have become physically worse, investors simply require a higher return to own it. In the first quarter of 2026, the aggregate implied capitalization rate for listed REITs was approximately 5.9%, but investors should not compare that number mechanically with a Treasury yield and declare the sector cheap or expensive. A REIT's cap rate reflects property income before corporate expenses, interest costs, and other adjustments. Treasury yields represent a different type of cash flow and risk. The more useful question is whether the REIT's stock price represents a reasonable value relative to the quality and durability of its assets. A REIT may trade below estimated net asset value, creating potential upside, but NAV is still an estimate. If the appraised property values use unrealistic cap rates or optimistic rent assumptions, the apparent discount may not be real. Valuation must also account for the cost of capital. A REIT trading at a depressed price may find acquisitions and equity issuance difficult, limiting future growth. And before moving into the second half of this analysis, this is the right moment to reinforce the principle behind the channel. If you prefer REIT analysis based on cash flow, debt, valuation, and property fundamentals rather than simply chasing the highest dividend yield, subscribe to Boring Money Wins. This channel is built for long-term investors who want clear explanations without market hype, guaranteed predictions, or daily panic about the Federal Reserve. We analyze REITs, ETFs, stocks, bonds, retirement accounts, and portfolio strategies by focusing on the factors investors can actually evaluate. If this video is helping you understand why high interest rates affect different REITs in different ways, click the like button. That simple action helps YouTube recommend the video to more investors who may be evaluating REITs based only on the yield displayed beside the ticker. The objective is not to make real estate investing complicated. It is to identify the few variables that separate a durable income-producing business from a balance sheet problem disguised as a bargain. And one of the most important distinctions begins with the type of REIT itself, because a company that owns buildings and a company that owns mortgage securities may share the REIT label, but they operate under completely different risk models. Most of the analysis so far has focused on equity REITs. These companies own or operate physical properties such as apartments, warehouses, shopping centers, data centers, offices, and healthcare facilities. Their performance is driven primarily by rental revenue, occupancy, property expenses, rent growth, development activity, property values, and debt costs. Mortgage REITs are different. Instead of primarily owning buildings, they invest in mortgages, mortgage-backed securities, or other real estate debt instruments. Their earnings depend heavily on the spread between the yield earned on their assets and the cost of the financing used to purchase those assets. Many mortgage REITs also use substantial leverage. As a result, they may be highly sensitive to changes in short-term funding costs, long-term interest rates, the shape of the yield curve, prepayment behavior, and credit conditions. A high-rate environment can therefore affect an equity REIT and a mortgage REIT through very different mechanisms. For an equity REIT, the central questions may involve tenant demand, refinancing, and property values. For a mortgage REIT, the discussion may focus more on book value, leverage, funding spreads, and hedging. The shared REIT label does not create a shared risk profile, and even within the equity REIT category, different property sectors can behave very differently under the same interest rate conditions. Interest rates create a broad financial backdrop, but property fundamentals remain sector-specific. Data center REITs may benefit from growing demand for computing capacity, but they also require significant development capital, power access, and infrastructure investment. Industrial REITs can benefit from e-commerce, logistics demand, and modern supply chain requirements. Their results may depend heavily on new construction, leasing spreads, and regional supply. Apartment REITs often have relatively short leases, allowing rents to reset more quickly. That can support growth during inflationary periods. But excessive new supply in a local market can pressure occupancy and rents. Retail REITs depend on tenant health, consumer spending, property quality, and location. Strong shopping centers may remain resilient, while weaker assets continue losing relevance. Office REITs face a more difficult combination in many markets: uncertain demand, expensive capital improvements, refinancing risk, and potential reductions in property values. Healthcare REITs may benefit from demographic trends, but operator health, labor costs, reimbursement systems, and property-specific demand still matter. The lesson is straightforward. You cannot analyze REITs as if every company owned the same property type. Interest rates matter, but demand, supply, lease structure, tenant quality, and capital intensity determine how that pressure is absorbed. Sector differences also explain why the highest dividend yield is often not the best opportunity. Sometimes it is simply the market warning investors that the payout may not survive. A double-digit dividend yield can look irresistible, especially when investors are searching for income. But the yield is calculated by dividing the annual dividend by the current stock price. If the stock price collapses because investors expect weaker cash flow or a dividend cut, the displayed yield rises automatically. That does not mean the investment has become safer. To judge dividend sustainability, start with recurring cash flow. Rental revenue must cover property expenses, interest costs, recurring capital needs, corporate expenses, and other obligations before the remaining cash can support distributions. For REITs, investors often use funds from operations or adjusted funds from operations rather than traditional earnings per share. But even those measures require analysis. A dividend may appear covered based on company-defined adjusted FFO, while recurring capital expenditures or leasing costs are excluded. Warning signs include a rising payout ratio, falling same-store NOI, weakening occupancy, large near-term debt maturities, repeated asset sales, or a dividend supported by external financing rather than recurring operations. A high yield can represent a genuine opportunity when the market is excessively pessimistic about a strong business. It can also represent a future dividend cut that has not yet been announced. The yield should be the final output of the analysis, not the starting point. Once quality, coverage, debt, and valuation have been evaluated, investors face one final timing question: buy now or wait for interest rates to fall? Waiting for rate cuts can feel like the cautious decision. Lower rates could reduce financing pressure, improve real estate valuations, and make REIT dividends more competitive relative to bonds. But the market rarely waits for perfect confirmation. If investors begin expecting lower rates or stronger fundamentals, REIT prices may rise before the Federal Reserve officially cuts. By the time the economic environment feels comfortable, part of the valuation opportunity may already be gone. There is also no guarantee that rate cuts will arrive for a positive reason. The Federal Reserve may reduce rates because inflation is under control and growth remains stable, but it may also cut because the economy is weakening, unemployment is rising, or credit conditions are deteriorating. That scenario could hurt tenants and property demand even as financing rates begin falling. For long-term investors, a more practical approach may be gradual buying rather than making the entire decision depend on one macroeconomic forecast. Dollar-cost averaging reduces the need to identify the exact bottom, although it does not protect against losses if the business deteriorates. The key principle is to buy the business, not the rate prediction. A future Federal Reserve decision cannot repair obsolete properties, excessive leverage, poor management, or an uncovered dividend. That brings the analysis to a final checklist that can be applied before purchasing any REIT in a high-rate environment. Before buying a REIT while interest rates remain elevated, ask 7 questions. First, is demand for the company's property stable or growing? Second, is net operating income increasing? And is that growth coming from existing properties rather than only acquisitions? Third, how much debt matures during the next 2 or 3 years? Fourth, how much of the debt is fixed rate and what interest rate might replace the maturing obligations? Fifth, is the dividend covered by recurring cash flow after realistic capital needs? Sixth, does the REIT have an investment-grade balance sheet, adequate liquidity, and access to multiple sources of capital? Seventh, is the valuation genuinely attractive relative to property quality, growth, debt risk, and estimated net asset value? The final verdict is not that high rates make every REIT a bargain. High rates create a filter. They expose weak balance sheets, reduce the value of distant cash flows, increase competition from bonds, and punish companies that depended on cheap capital. But they can also create opportunities to buy durable real estate businesses at more reasonable valuations. Strong REITs can survive a high-rate environment. Weak REITs may simply look cheap while their fundamentals continue deteriorating. Do not buy because the dividend yield is high. Do not avoid the entire sector because Treasury yields are attractive. Buy durable cash flow, manageable debt, valuable properties, and competent capital allocation at a sensible price. That is not exciting, but that is exactly how boring money wins.